Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. Welcome on in today for this morning's call where we're going to be talking about the recent construction update by Fortuna Silver at their Séguéla gold project. Fortunately, joining me to dig in is Jorge Ganoza from Fortuna Silver, as well as some analysts that you've both seen on the show, Dave Kranzler of Investment Research Dynamics and Rafi Farber of the Endgame Investor. So before we get started, how are you all doing today?
Well, Chris, glad to be back.
Well, it's good to have you on here. I know we have a lot of people in the audience who follow Fortuna, shareholders of Fortuna. So Jorge, why don't I hand it over to you and I'll pull up the press release that you guys put out recently and perhaps you can share what you'd like folks to know.
Sure. Well, we have an important development going on in Ivory Coast in West Africa. We believe Séguéla is going to be a flagship asset, a flagship mine for the company, and we are sharing constantly updates on how the construction is evolving. Particularly knowing that there is, we are in an inflationary environment, and shareholders, investors are quite keen to learn how inflation is impacting the business, right? The construction is going really well. So I don't know if you guys have any specific questions or you want me to dig into how things are going just in general.
How's the cost of construction that's being realized compared to what you had modeled before you started?
That's a good question. Last year, we published a feasibility study in early 2021, calling for $142 million in construction capital, right? That was total construction capital. So that was published by the previous owners of the project. As you recall, we acquired Roxgold. We closed the acquisition of Roxgold, owner of the Séguéla project, in early July of last year. And we took, after closing the acquisition, the project was ready to go into construction. But we said, knowing about the type of inflationary environment we were in, we said, let's wait and let's take time. Let's take 3-4 months to bring into consideration these inflationary pressures that we are seeing, right? So as an outcome of that exercise, we hiked the construction capex from 142 to 173 million dollars, roughly 17% increase, accounting for inflation. And we deployed a strategy to mitigate continued inflationary risks beyond the things that at the time we were able to see and model, right? I mean, so for example, before going public with the construction decision as part of our construction strategy, we went public with the construction decision in September of last year. So before doing that, we advanced detail engineering as much as we could, minimizing that transition risk from basic engineering to detail engineering. We advanced an $11 million pre-construct early works funding of $11 million to lock key equipment packages. So with that, we locked prices and we awarded to Lycopodium an EPCM contract with a closed lump sum for the delivery of the processing plant. It's roughly an $85 million contract, which is 65% of the total capex. So knowing the type of inflationary environment we were in, we deployed a strategy to minimize our risk of exposure to inflation. As a result of that, Today, we're 63% complete with construction. And I'm happy to say that we are not seeing any deviations with respect to what we guided in September, with respect to timeline and budget. We are well within budget. We have not touched our contingency funding as of yet. And we are geared towards delivering first goal in May of next year. Yeah.
So when you say the guidance in September, that's the 173 million that you budgeted?
Yes. I mean, no doubt there is inflation, right? Mm-hmm. That we are not showing inflation deviations or cost pressures today is not the fact that there isn't inflation, is the fact that we did a good job before going public in capturing all of this. So there are no surprises. We were able to plan or funding for the project with these considerations in mind, no? So basically we brought in around 24, 25 million additional dollars to our construction capex as a result of that inflationary assessment exercise right before going public with the construction decision. So inflation is very much there, is very much real. With our strategy, we have mitigated risks of deviations, right? But we're dealing with it.
That's phenomenal. That's incredible.
Yeah. You know, I watch very closely, as you can imagine, constructions in the mining sector all over the world. And I see the pain and grief some of our peers are going through. And I attribute this to, you know, or we're not complete, but our success so far, and we have crossed the middle line of the construction. And I think it's one, we're building in Ivory Coast. And Ivory Coast might sound like an exotic place far and away in Africa, but it's very much a well-established mining jurisdiction. We have services, expertise that lend to an effective construction, and that's very important. And second, lessons learned through the years, right? We have deployed with the team a strategy that helps minimize the room for surprises for us and our shareholders. Yes.
So Jorge, I have a quick question. When a lot of the questions that I deal with, people that ask me all these questions all the time on finance, is should I buy a house now, or should I buy real estate, or should I wait until the dollar collapses and then use my gold or silver to buy a house? So I guess the equivalent here would be, I think you're describing, you sort of have like a fixed rate mortgage on the Séguéla project because you've locked in so many of your costs, right? So you're basically paying the same amount a month, you know, using different tools. You know, you're not using a mortgage, but that's basically what you have here, as a fixed rate mortgage on gold production.
Absolutely. Absolutely. We were able to negotiate what eggs to a fixed mortgage rate, and we try to get on board the more experienced and partners for the construction with broad financial shoulders. Again, and we tried to lock in as much as we could as early as possible, right? Trying to protect ourselves from ramping inflation, which is what we're seeing, right? Yeah, I think the analogy you're making is right on, right? Yeah.
Okay.
I think to extend that, I mean, I remember when you made the acquisition and there was a lot of criticism thrown Fortuna's way. And one of the things that you had said was that we can use our balance sheet to create synergies, and we'll show you as we develop Séguéla. And I mean, you're putting your actions where your words were.
I see it is quite evident that investors in mining equities and investors in general across sectors are risk averse, particularly mining with constructions, right? Because of the theme of inflation. So we liked Séguéla, Roxgold for several reasons, but some of those were one, the Séguéla construction wouldn't put strain on our balance sheet. It's a $172 million build and well managed. It's not a risk to our balance sheet. We run with a debt to EBITDA ratio of under 0.5. So we're not highly leveraged. We have a robust balance sheet. We're building in a place, and I cannot underscore this enough. A similar build like this in a non-mining jurisdiction would be twice the amount. The value of building in a jurisdiction where you have an EPCM like Copodium that has just built over the last 6 years, 6 mines, right? So that local expertise, the filtering process as you go build to build, you learn, right? You become more efficient, more effective. You can segregate which are the good engineers from the bad, which are the good subcontractors from the bad, and the machine becomes more efficient, right? And that efficiency is translated to the client in more competitive costs, right? So I cannot underscore enough the value of building in a place like Ivory Coast. And again, to some, Ivory Coast sounds like far and away in Africa and risky, but from the perspective of mining, it's a great place to do business, right?
Well, that
Jorge,
makes sense.
sorry.
Go ahead,
Oh,
Rafi.
Chris, go for it. Can I ask another question?
Go ahead, please.
I got it. Okay, so I've been wondering this. I've never actually asked this to a mining executive, but the other big question that I get from people interested in silver equities and gold equities is, let's say silver goes down to like $10 like it did in March 2020. And I remember you saying that your company is built, Fortuna is built for even lower silver prices, and you can handle it. My question is, we saw in 2008 that silver was smashed for maybe 3 or 4 months, and then in March 2020 it was smashed for like 2 or 3 weeks. Did you, during the March 2020 crash, when silver went down to like $10 or whatever it was, did you see how much damage did that actually do? Did you actually sell any silver for that low, or was it just such a flash in the pan that it didn't really matter and you didn't see that? How long would silver have to really go down for you to actually see some negative feedback on your top and bottom lines?
Yes, I've been in recent years, the March 2020 and 2008 are sort of times where we have seen flash selling, right? 2008. But this business, steering a mine is like steering a large tanker, no? The turning takes a long time, right? There was no strategy we could implement in such a short, or tactics we could implement in such a short time. So to your first question, we just stayed the course for that short period of time, right? We continued selling. We do not hold sales. We don't do that. Perhaps within the quarter, we hold sales through the months in the quarter. But at the end of the quarter, we try to clean our inventories, right? And that did not change in our particular case. So short term, again, for us, we just continued with business as usual. But each company will have a different strategy, Rafi. And in our case, as I have said in the past, we want Fortuna not to be your most leveraged vehicle to silver or gold. That's not our strategy. That's not what we offer our investors. We're not the most leveraged. We want to be your best call option. And what do I mean by that? I mean that we all believe gold and silver, particularly in the type of environment we're in right now, has to move higher, right? There has to be a moment of reckoning with the truths and circumstances around us, and this has to gold has to emerge as the true store of value, no? But while that happens, we can see some pain, we can see some lower prices. And what I want to offer investors in Fortuna is a vehicle that you can be comfortable that if prices drop to $10, like you said in March 2020, $10, $14, and stays there not for a month or for a week, but for 6 months or a year, Fortuna is a business that continues thriving, right? Currently, our all-in sustaining costs hover around $1,000 per ounce, $1,000 to $1,200 per ounce today on our gold assets, and on our silver mines, we're around $16. But that is all-in sustaining. So our mines are well developed, and this is a strategy, are well developed. So I could cut for a year or two exploration, $30 million a year. I could cut certain investments on sustaining. We invest annually between all the mines around $75 million a year in sustaining capital, and that is to keep the mines developed well ahead of production. I have the mines, I could cut development for 2 years and still be producing for 2 years, right? Wow. So I have the flexibility to bring my all-in sustaining cost closer to the true cash cost, right? Of breaking the rock and running it through the mill. But in all-in sustaining cost, we have the cost of breaking the rock, running it through the mill, plus investments, right? There are some investments that we cannot postpone, but we're always, when times are good, we're more generous and invest for the difficult times. And that's what we've been doing. So if times demand, we can cut our budgets or capital budgets significantly and don't impair our ability to feed the mills, at least in the short to medium term. So that's a strategy that we could implement, and that would bring in silver or all-in sustaining or cash cost, closer to $10, $12 in the short term, and in the gold assets, well under $1,000, right? So those are strategies that we could use if we see sustained depressed prices. And if we see sustained depressed prices, you also start capturing other opportunities, like, costs for services will go down and you gain more negotiating power. This is a boom and bust industry, right? So it's full of bottlenecks. So for example, right now we're having to implement very aggressive retention plans on personnel, right? In an environment of lower prices, new mines are not being built, everything stalls. So for example, that's an easy one, right? Your aggressive retention plans are reduced, right? There is only so many people with 15, 20 years experience at least building mines in this industry, right? How many new mine engineers, young guys going into mining, do you guys know? Not many, I'm sure. Yeah.
That makes sense. And Jorge, we have a couple of questions coming in. One is about the timeline. Perhaps you can comment anything you could add there of when metal comes out of the ground. I know you're expecting first pour next year. So anything on the timeline, and then along with that, how that will leave the mix of gold to silver percentage.
Yes, undoubtedly with Séguéla coming into production, or silver contribution to revenue will drop on a consolidated basis. We're currently at around 22%, and it will go down to the high teens. With respect to timeline, as I said, we're currently 65% complete as of last report I got. We're placing concrete equipment. Crushers are arriving on site. We're well advanced with the tailings facility, the water storage facility. So we just got confirmation from our mine contractor that the large truck fleet has been confirmed for delivery by Caterpillar in November, which is right when we need it to start doing pre-production at the main antenna pit. So, you know, with respect to timeline, so far we're feeling very, very good. No, I think we have good outcomes with the work we've been doing. And so May, June next year looks very, very solid for first gold. And, you know, that should take our consolidated gold equivalent production. That's converting, doing some alchemy and converting silver and the bit of base metals we produce as gold. That should take us to roughly 450,000 ounces plus gold equivalents annually at an all consolidated all-in sustaining cost in the range of $1,000 per ounce, right? And again, we continue pursuing silver opportunities. But you know, the conundrum for a silver producer is how to grow with quality assets in the silver space. That's why you see most silver producers gravitating towards gold. You know, we talk about Pan American Silver, for example. Pan American Silver, a great company, you know, Ross Beatty, Michael Steinman, a friend of mine. And silver contribution to revenue in Pan American Silver, I believe, hovers around 30% or even lower today. Fresnillo, the large Mexican silver mining company, silver at Fresnillo contributes less than 30% of revenue. So any large producer of consequence, it will be difficult to see silver at 50% of revenue at least. I think First Majestic, Keith knew, I think Keith is under 50% today with silver contribution to revenue as well, right? So that's a challenge for a silver producer, no? How to grow your business, keeping healthy margins, and keeping silver at or above 50% of contribution to revenue. You have to go to very small companies with one or two assets to find that kind of higher leverage to silver, right? But those are smaller companies.
Yeah, and actually one question along with that, I noticed an interesting comment from Paul Criddle in the press release you guys put out, where he talks about Séguéla continues to advance through what is a challenging supply market. The numbers from the Silver Institute show a deficit the last 3 years. Obviously, as you talked about, costs are going higher. It's not an easy environment. I'm wondering where some of that metal is coming from to meet the gap, but obviously you're seeing that firsthand. Anything you could say about the general silver supply market and anything that'd be insightful for people who are wondering where that's going to continue to come from?
You know, 1/3 of silver mine supply comes from what we call primary silver producers, pretty much, and 2/3 from base metal mines, right? Large copper mines. So we are seeing some new developments and expansions of copper assets. We might see some silver coming out of there. The recent hike in lead and zinc is probably driving expansions. I don't have the statistics for the base metal producers, but with respect to primary silver producers, which again, we only account for, and again, we're not, as I said, none of the silver producers that we call silver producers are in reality primary silver producers either. We account for a third of annual production. And we know that there are a couple of very good projects coming in, like Silvercrest and coming into production, and Max Silver at Juanicipio with Fresnillo are advancing with their production. So that's fresh new silver coming. But in my view, and again, I'm not as studious as the markets as you guys are of the silver market, but I think that when we see a wave of investor buying, there's no silver we can supply that it's enough. So investor demand really, I've seen that in the past, in previous cycles, and when you see that wave of interest coming towards the metals, there is no one can supply that. So prices concurrently go significantly higher, which is what we're not seeing yet, right?
Well, it's going to be an interesting environment, especially with where we're at now, the money printing that's going on, the carnage in the overall markets, and then leaving that factor of not easy to find new deposits. I hear it's not getting easier for the copper, lead, zinc miners either, especially with the volatility in the commodity pricing and just trying to get metal out of the ground in this environment. So appreciate you sharing that. And Dave or Rafi, any final questions before we wrap up today?
I don't know. We got a pretty full plate here from Jorge. I appreciate you taking the time to update us on Séguéla. And, again, I think that I remember when you guys did the acquisition, you'd say eventually the market will come to realize, what a great acquisition this is and how well it'll fit, even though it's in a different part of the world than the rest of our assets. And I think you're proving that out with the construction and advancement of Séguéla.
Yeah, the Yaramoko mine is generating significant free cash in Burkina Faso, and the Séguéla construction is advancing well. And I have to say that the governments of those countries and in general the region are very receptive to investment in mining. We feel very comfortable, and it's a good place to do business. And we feel as comfortable as we see across the Atlantic on the LATAM side. So it's it was short-term pain for long-term gain, but those are decisions that we as stewards of a mining company sometimes have to make. And I believe that numbers will tell the truth, right? Yeah. And again, with respect to the general state of the markets, it's a bit perplexing what's happening. And again, I think things need to balance out here. And I think investors have been distracted largely by other asset classes seeking returns like lithium,
uranium,
Bitcoin, and we're seeing bubbles bursting in all of those sectors, right? So as a store of value, I think eventually everybody will circle back to the basics and fundamentals, right?
Well, I don't expect when the crack up boom finally hits, people are going to be chasing lithium and uranium. I just don't see that happening.
Yeah, and the best way I understand it is investors have been distracted, distracted by all of these other asset classes, like these stories about. And don't get me wrong, I subscribe to the green energy and everything. We measure emissions. We try to be more conscious about how we manage emissions and whatnot. But in the meantime, we have created bubbles around those stories, right?
Yeah.
And Tesla, 180, times earnings. Lithium, nickel, we talked in one of your programs what happened with the nickel in the LME, which is ridiculous. So we're seeing those excesses pop everywhere and bursting as well. So I think investors have been distracted by those returns, right? And the returns provided in those other asset classes. And eventually people will realize, well, the store of value has been there for thousands of years. And for some good reason, it's gold, right? Yeah. And silver.
Well, I think a lot of us are ready. And at least when you look at what's happening in the world, that's where I come back to. And just appreciate all that you're doing out there, Jorge, and appreciate you joining us for today's call to give investors and the shareholders an update. Dave, appreciate you checking in as well. Good to see you as always. And Rafi as well. We'll look forward to your report tomorrow. And again, just before we wrap up, would mention that for any of the details to review the press release, you can find that at fortunasilver.com. And with that said, hope everybody out there is having a great morning. Appreciate you tuning in, and we'll look forward to seeing you again soon.
See you guys. Thank you.
See you later.
All right. And we are